Hi, Steve Sosnick here with an Interactive Brokers midday market update for Tuesday, June 7th, 2022. Figured we haven't done one of these in a while, just me talking to you on video, so we'd give it a try for today. As we look at the markets now, we opened at our lows. We've since recovered to be off those lows. I think this is what we're going to get. This is volatility, folks. It moves in both directions, and that means we overshoot in both directions. It also means that the moves are a bit more magnified because, as we've discussed, liquidity tends to be lower when markets are volatile. Market makers don't provide the same type of liquidity that they do when markets aren't moving. Each trade they do is riskier. As a result, they compensate by shrinking their sizes or widening their quotes. And this is what we're seeing that leads to a bit more volatility. On an intraday basis, on the overall basis, that's not really an effective market makers. That's really how individual investors and institutional investors are reacting to moves in the market. The cause for today's decline, at least on the start, was the World Bank downgrading growth assumptions and Target announcing for the second time in 3 weeks that they have an inventory issue. They simply have too much on the books. They're going to have to cut their inventories. That's never a good thing. We alluded to this 3 weeks ago in the wake of Target's and Walmart's earnings announcements, where they mentioned that they had a bit too much inventory on the books, and that while this doesn't mean that we're at an inflection point in the inventory cycle, it's certainly not helpful to that motif. Let's put it that way. So, thinking in those terms, you have to break out. Does this mean that the consumer is strapped or not? I think it depends on the consumer. Obviously, if you have a very high income, the extra income that is having to be devoted to food and gas and energy may not make a huge difference to you. It stings. It stinks. We don't like it, but it's not meaningfully affecting the high income consumers necessarily to the same degree. If you're a modest income consumer, yes, it does. It costs you more to go to work every day, and you have no choice. But you have to fill up the car and drive in many cases, particularly if you don't live in a city where there's public transportation. Putting food on the table, you have to do that no matter what your income is. And as a result, if you're of modest income, that's going to hurt. Inflation acts as a tax, but it's a regressive tax in many cases because its effects are often most acutely felt by those with the lowest incomes. This is where the problem may come in for Target, being sort of at the high end of the big box store grouping. Many of their consumers may be trading down. They may be finding that they don't have the disposable income to spend at Target. They have to go to dollar stores or the like, maybe to Walmart, maybe even below that, sort of on the retail food chain, so to speak. Or they may be postponing discretionary purchases altogether. I think that's why you still see, airfares being high, travel and leisure being high. I think people with incomes are still spending the money they have. But the problem is, particularly if you have a lower income, you're being forced to spend it on the necessities of life, a greater percentage on the necessities of life. So that becomes quite difficult for many to achieve. Sorry. Going forward, what does this mean? I don't know that we're at an inflection point in the inventory cycle. I still don't see it yet because we've heard it from Target and Walmart. I do think they got a little aggressive trying to get around supply chain issues, and now they're kind of stuck with the merchandise. It's a little tough to manage. Let's see how that goes. In terms of the markets, the fact that we opened lower, bounced up, this is volatility. We've discussed it. Volatility works in both directions. You see this. I think this is what we're going to continue to see. Yesterday we opened higher. There was enthusiasm about China reopening, how that would be good for the economy. Of course, that then weighed on bonds, where bond yields spiked up, which then brought stocks lower. It's this weird, crazy cycle, right? Bond traders don't like a stronger economy. Ultimately, that started to weigh on a lot of U.S. stocks, and down we went. A lot of the enthusiasm yesterday was for Amazon post-split and Google ahead of its split next month. We've discussed this. There's a psychological aspect to it. Yes, in the old days when stocks used to really trade in round lots and odd lots were discouraged and fractional shares didn't exist, it was meaningful to have a stock split. It really did make stocks more affordable. Now, it really doesn't make that big of a difference. If you could buy a fractional share, or you could you're not disadvantaged if you buy one share of something. So yes, it does make the stock more affordable, but there's a psychological aspect. If everybody believes something is going to be true in the market, it can be true for a short period of time. And that's kind of what we saw with Amazon, kind of where we saw people preemptively moving toward Google. We've seen it in the past. I don't think. I think in the case of a stock like that, it's a bit of a sugar high. It's quick. It doesn't have a long-lasting effect. We have written various times how stock splits do really increase the affordability of options for option traders. I'll link to that. You could read through the stuff I wrote on Alphabet and on Spotify, neither of which have actually split yet, but Amazon has. And I think this would have made a huge difference last year when people were really utilizing call options for speculation. Now we're not seeing that kind of speculation via call options. We're seeing more balanced trading. So it does make a difference. And I think if you watch this and you do trade options, you should be cognizant of it. But in and of itself, I think that's a less meaningful piece of market movement than we might have expected. So I wouldn't. You can decide whether you want to buy or sell Amazon or Google or Spotify, but don't do it strictly because of the split. That if you're going to do it because of the split, understand that that's just a trade. It's not really meant to be It's meant to be meaningful, but it really shouldn't be. You're making change. As I mentioned before, you're getting 20 singles for a $20 bill. Okay, you might like that, but it doesn't really change what's in your wallet. And so here we stand going forward to today. There's a lot to unpack in here. I don't want to belabor it, and we'll talk again soon. Take care. Bye-bye.